Here's the deal, guys. I can't say guys, dude. Here's the deal. Bring it in. Bring it in. Come here. Closer. Here's the deal. The active trading culture online is cancer. I'm going to say it. And it's basically a lie that is being spoon-fed to everybody. And you'll see it regurgitated by people on Reddit when you talk about something and they go, actually, no, you need to have a stop loss here and your position sizes needs to be a certain percentage of this and your risk-reward ratio has to be this. Otherwise, you're just not going to make money statistically. Trust me, I did the trigonometry on it. It's especially dangerous because there are so many new people in the markets right now. After the initial GameStop debacle, when it initially squeezed, okay, maybe there's going to be another squeeze, whatever, I don't care. The initial squeeze brought so many people into the markets. Wall Street Bets grew like 7 million new members or something like that. There are so many new people in the markets walking around and you can't see their faces. You can't see how much knowledge they have because they're hidden behind a username in a computer. And they're acting as if they know everything. So there's millions of people, fresh new people in the markets who've been in the markets, like literally learned about the stock market in the last 3 months, that are spewing information like it's fact, and you have no idea if this guy is like a 60-year-old trader who's been doing this for decades, or if it's a guy who literally just got weaned off his mama's titty. It's usually the latter. What was I saying? Okay, just be aware of that. And in addition to that, the active trading culture online is cancer. I don't know if I said that. Did I say at the beginning? It's cancer. And the reason for that is they constantly spoon feed this idea that you have to be super high frequency. Like you have to be a market sniper. And it sounds very badass. They layer it and wrap it up in this beautiful package of badassery so you feel cool if you do it. But they market this idea of high frequency trading is be up at opening bell, have all your screeners open, be scanning through a bunch of different options and underlyings, but also understand all the technical indicators that you should be using, and you should have 30 of them on your screen, and you have to be on the Johnny on the spot at all times. But the problem with that is it's just busy enough that you're going to fail. But it's also just specific enough that when you fail, you're going to think it's your fault and not the people who are shoveling this garbage into your mouth hole. Active trading culture is a scam, is basically what I'm saying. I mean, they'll actually tell you to your face, and that's how naive some of you guys are, no offense, sorry. They'll tell you to your face 99% of traders fail. And yet you'll think you're the exception. You're the 1%. Because if you just try hard enough, if you just study hard enough, you'll be better than everybody else. Newsflash, a lot of people want to study hard for money. That's what everybody basically does, is they study hard for money. If there's money involved with something, people are trying their damn hardest, all right? Some guy just pretended to be my grandma to try to get money from me, okay? People will do anything for cash, including study very, very hard. My point being that even if you study hard, I mean, your odds of being successful maybe increase slightly, but it's still going to be around 1% if you're planning on doing very large position sizes, day trading or options trading. Doing very, very active trading, the odds of success are very, very slim. And yet the odds of you thinking you're going to be the exception one day are very, very high because these people are marketing this idea that you're going to be just smart enough. If you study hard enough, if you work hard enough, you'll be able to figure out the markets and make money consistently. I mean, doesn't that sound familiar? You've probably heard an ad like that, right? So how do you be successful trading options? It's ignoring those people. It's ignoring the day traders. It's ignoring those people who say you have to be super high frequency in order to succeed. It's the exact opposite of that. The more high frequency you are and the more intense you are, the more emotional you are, and also probably your position sizing's all messed up. And it's gonna be so intense that it's gonna put you off your game. It's too much to handle. You're too microscopic. You're too zoomed in. You're too not patient. So when I look at people like, what's that guy's name? Ricky Gervais, or I don't even know what his last name is. When I look at his channel, I'm like, you're misleading a ton of people. And to be fair, people look at me and they go, Adam, you talk about options. Options are highly leveraged derivatives. Fuck you. You're trying to poison people's minds and lose their money for self-gain. That is so far from the truth, because options can be utilized in a way that give you more cash only if you avoid that cancerous shit you hear online about active trading, about you having to be Johnny on the spot, about you having to be really active. You should be doing, 20 trades a week, whatever. If you ignore all that and you listen to your boy, you can be successful at options trading. So here's how I handle options now. And it hasn't always been the case, but through trial and error, like everybody else, I figured out this is the most consistent way to make money. And there's not one bead of sweat that gets juiced out of one of my pores due to anxiety when it comes to my money. How do I do it? Number one, position sizing, tiny. Real tiny if you can. And if you can't, then don't trade options. For me, I love leaps. 10% max, roughly, maybe a little bit more, a little bit less. So not max, I guess is what that is, goes to leap options. And there usually are about 2% of my portfolio. What that allows me to do is it eliminates the possibility of panic selling. If I have a position that's 20% of my portfolio, which come on guys, I know you guys out there are doing that with options that expire between a week and 2 months. Not a good idea, and that are at the money or out of the money. If I do that, without fail, there will be a moment where I'm like, should I sell? Because it took a dip and I've lost 50% of the value of the option. Now I only have a month left until expiration. You're going to have that feeling of like, oh, sweet Jesus, if I just sell now, maybe I'll save $500 and I'll just recoup it. It'll be fine. And then you panic sell. Having leaps, what that allows me to do when they're 2% of my portfolio is it allows me to not panic sell. I'm not concerned if that leap eats shit and dies, and I never see it again, and I bury it, and I say a few words and just sprinkle some dirt on its face. That's fine, because it's only 2% of my portfolio. And yet if it does well, if the underlying of that option increases in value, because it's a leveraged instrument, it's going to act as if it's more than 2% of my portfolio. And so it's going to accelerate my gains quite significantly. So now I'm just opening my upside potential while eliminating the risk of selling while I'm down, which is probably the biggest problem everybody has with trading. And that can be with leaps. It can also be with standard options as well. Sometimes you guys want to take extra risk, and that's fine. For me, leaps, I love leaps because they have such a small amount of extrinsic value, and they're, if they go really, really against me, maybe in the next expiration cycle when this leap option is about to expire, I'll open a new one to keep that leverage going, assuming the stock will start rising and recoup my losses. It makes it very easy to keep the trade alive and to recoup losses because it's very similar to owning 100 shares. But maybe you guys want to do a little bit more riskier trades like at the money or out of the money options. Well, if you keep that to 1% or 2% of your portfolio, then great. You're not going to have a problem with panic selling, and you'll only sell if you make money. And your loss, your defined loss, your stop loss of the trade is the value of the option. Because of course, with options, the most you can lose is how much the option is worth. But particularly if you want to be successful, like more consistently so, and still have plenty of leverage, go with leaps. Video in the corner, of course. Now, some of you guys, of course, might be saying, Adam, I don't have all the YouTube money that you have. What am I supposed to do? Well, here's the deal. If you can't afford a leap option and it's going to be more than 10% of your portfolio, 20% really max, but 10% really you shouldn't be go over 10% in my opinion. If you can't buy a leap option without it being more than 10% of your portfolio, then use spreads. Use a debit call spread, far out expiration. They're not as preferable because you're dealing with two legs instead of just one, so they're going to be less liquid. You're going to give up a little bit more money getting in and out of the trade. And if they get too illiquid, you could be giving up a lot of money versus with a leap option. If it gets too illiquid, I would just exercise it. I would give up extrinsic value through exercising, but that's so small, it wouldn't really be that big of a deal. So I can exercise if liquidity gets too poor. Can't do that with debit spreads, but still, they are a way to reduce the buying power while increasing your leverage so that you can simulate a leaps kinda. You just have a long, a leverage position that's long on the underlying, right? That requires less money, so it's easier to buy. Okay, so there's that. I make sure that if all my leap options die, they perform terribly and die, that I'm not going to be in financial ruin. And that also means that maybe for a lot of your leap options, don't also buy shares on them. Keep your leap options underlyings and your general long-term investment holdings maybe separate, different stocks. Okay, so I do that. I do leaps, right? Love leaps. Don't have to worry about it. Low break evens, all that jazz. Then I do long-term investing, right? I have like 15 to 20 stocks that I like. Other companies I use, have used, would like to use. If I could afford it, I would use those kind of companies. And I understand how they make money and I appreciate what they're doing. Do I look into the fundamentals of every single company and make sure that they're doing fantastic? No, sorry. I barely got my finance degree. You think I really care that much about fundamentals? As soon as we start talking about fundamentals, I get put right to sleep. Listen, if that's your thing, that's fine. But if I see a company that I use and I love, odds are they're going to perform well. Sure, I'll take a look at their fundamentals briefly, very briefly, just eyeball the basic ones, PE ratio, earnings per share, cash flow, and then maybe go to Seeking Alpha and see what other people think about it. But I'm not doing some super intense research. I just like the company. And that's the edge that retail investors have, is that they are involved in a certain industry or sector or specific company, not insider trading, not saying that exactly, but you have an edge because you know companies and you know certain industries and how they're doing and what the future holds for them. That's your edge as a retail trader versus some financial analyst at a prop desk who has no idea what the industry is actually doing. He's just looking at numbers at a piece of paper. So he doesn't have that intuitive human involvement that allows you to, What am I trying to say? You get what I'm trying to say. I'll stop. Okay, so I have leaps, I have long-term investments. Okay, don't buy 100, 200 stocks. You can do index funds, it's fine. You won't fail if you do index funds, but odds are you'll get a worse return. So pick stocks that are sensible, that you've heard of before. You didn't just find off the internet and it's like got a ticker called XQSV, like no one's heard of that stock before. Pick a stock that's a good stock of a company that you like, that people use, that you know of, and you think their products just kick ass, and get involved in it. Okay, so leaps, long-term investing, and then theta gang. For me, particularly, theta gang involves cash secured puts and covered calls, and using those together, running the wheel. If you don't know what that is, video up in the corner. And me personally, I sell puts. I don't sell cash secured puts really. They're more like naked puts. I sell puts on margin, meaning I use up all my buying power and then I sell a put. So that way my brokerage doesn't take any of my actual money aside as collateral to make sure I can buy 100 shares at the strike price in the case of assignment. Instead, it doesn't take any money away. And when I get assigned, I'll buy those shares on margin, and I can either deposit funds to make it so I'm not using margin anymore. I actually pay for the shares myself, so I'm not paying interest on margin. Or if my margin rates are affordable, I can just own the shares on margin. And a lot of people freak out about margin, but if you're smart about it, it's not that big of a deal. You should always make sure that, if you had to, you could buy those shares outright. Okay. You don't want to be using margin and you have no money anywhere else to pay for that margin. You want to use margin if you just want to keep your, some money in your bank account because you have some stuff coming up, but in the next few months you'll be able to cover it. It won't be a big deal. But really, it's most useful because the whole time that you sell this put and it's not been assigned yet, you're not having money locked up. You can have that money invested. And it takes a long time if you're doing it right, it takes a long time for a put to get assigned. Okay, especially on a good bullish stock. It takes a long, long time for a put to get assigned. And that whole time you could have your collateral invested somewhere else accruing interest. And then when you get assigned and you buy it on margin, you can sell that position and use those funds to pay for your shares over here and then invest whatever capital returns you made on that investment. So that way you're maximizing the amount of money you're making. You're not having any cash held hostage. Okay, so I love the wheel. Okay, that's my theta gang strat is the wheel. But if you can't afford to sell cash secured puts because you can't afford to buy 100 shares of the underlying stock, then just do credit spreads, I guess. Credit spreads are fine. To be honest, they kind of suck, actually. Managing the wheel is so much easier. It is so much easier just selling individual puts than selling individual calls. You only have to worry about one leg, and it is very easy to understand. You don't have to... Adjusting credit spreads can get really difficult. In my opinion, it's just it's a layer of complexity that just isn't necessary. So I guess, if I'm being honest with how I feel, if you can't sell a cash secured put, then just stick to leaps and in long-term investing. If you can't afford leaps, then do debit call spreads in long-term investing. If debit call spreads is still going to be too much, then guess what? You don't have enough money. You should be doing long-term investing exclusively. Meanwhile, go work your ass off and make some fucking money so that you have money to invest. You should never look at your investments or your trades or anything as your main means of income. And you have a whole life over here outside of trading and investing that needs to be developed. You have to grow yourself professionally somehow. Just keep working on making money. I know it's hard. It's hard. All right. It's hard. It's not easy. I lucked out with this gig. Okay. So I'm really like up here on my high horse talking down to you when really I just stumbled into this by pure chance. And every time I fart, somebody wants to pay me money. So it's not really fair for me to say that, but I'm just saying you should be trying to develop yourself professionally. And if you disagree with that, then, come on. Okay, so don't force it is what I'm trying to say. Just don't force it. If you can't sell cash secured put because you can't buy 100 shares of any underlying that makes sense, okay? Don't do it on some weird, stupid penny stock on an underlying that makes sense. Then just stick to leaps in long-term investing. If you can't afford leaps, then debit call spread in long-term investing. If you can't do that because it's still going to be over-allocated to debit call spreads, like over 10% to debit call spreads, then you need to just stick to long-term investing. And no matter what you're doing, grow yourself professionally, try to keep making more money so you can at least put more money into your investments. And once your investments start growing and you can start incorporating debit call spreads, then do that. And once that starts growing and you can incorporate leaps, then do that. And once that starts growing and you can afford to sell a cash secured put because you can afford to buy 100 shares of the underlying of some actual reasonable stock, then start doing that. Don't feel like you have to do all of this at once because it might not make sense and it might put you at risk when you really shouldn't be putting yourself at risk. You don't want to be selling a cash secured put where if you had to buy the 100 shares at the strike price, you'd be freaking out because you're using 50% of your margin in the stock. If your investments drop by 20% in value, you're going to get a margin call and then you have no money left because you don't even have a pile of savings saved up, an emergency fund. For the love of God, have an emergency fund. That's how you be successful at options trading. You don't be successful by trying to find patterns all the time. Okay, you can use technical analysis to find better prices for your options. You know, if the stock price is going to drop, you use technical analysis, you think there's a downward trend and the stock price is going to drop, you'll be able to buy a long call option, a call leaps for cheaper. So you can use technical analysis in that way to enter a limit order that's cheaper than the current price for that option and improve. It's just price improvement, basically. But if you're just using technical analysis and patterns to base all your trades off of, hello, you just fell for the biggest scam in trading culture. Technical analysis is not BS, but making money consistently solely on technical analysis, very, very hard, to the point where it's basically BS. Okay, there you go. That's my trading philosophy in a nutshell. So if you ever wonder, what's Adam doing? This is what I'm doing. Leaps, running the wheel, long-term investing. That's it. I'm making tons of money. How much am I up today? Oh, up $1,500 today. All right. Love you guys. Be safe out there. Good luck. And, you know, all sorts of stuff in the description. If you want to help me out, don't be stingy. All right. Go look in the description. Find some free stocks or something. Surely you can do something down there. Definitely follow me on Iris to see all my trades. I'll catch you later. I love you. That feels weird leaning down like that. I don't know if I like that. All right. See ya.